Welcome to this week's Market Update, where we review the key developments that shaped markets, highlight what drove our recent performance, and look ahead for important events on the horizon. Let's start with what moved markets this past week. The big story was Fed Chair Jerome Powell, preparing for what will be his final speech at Jackson Hole, marking the end of an era for America's central bank leadership. While investors hope for clear signals about September rate cuts, Powell is likely to focus on maintaining the Fed's independence from political pressures. This matters because the Fed's credibility depends on making decisions based on economic data rather than political influence. For investors, this balanced approach should provide more predictable policy decisions over time. Our bond and stock holdings benefit from a Fed that follows consistent policies. While markets want immediate clarity on rates, Powell's emphasis on independence actually strengthens the foundation for long-term investment success. Treasury bonds found their footing as investors recalibrated expectations for September rate cuts. The 10-year Treasury yield held steady near 4.33%, even as market expectations for a rate cut dropped to about 65%. It's encouraging to see that bond investors are no longer overreacting to every Fed comment or inflation report. This measured approach creates opportunities to capture attractive yields while positioning for potential gains if Fed rate cuts arise. Bonds now offer both meaningful income and the possibility of price appreciation. And after 5 consecutive days of losses, US stocks showed resilience, with the S&P 500 futures gaining 0.2%. This measured response suggests the market has learned to avoid overreacting to policy uncertainty. Different sectors are also taking turns leading performance, suggesting more broad-based strength in corporate fundamentals. This environment rewards companies with strong business models and clear competitive advantages. Whether the Fed cuts rates aggressively or moves cautiously, quality businesses should continue generating solid returns for patient investors. Now let's look at what drove our performance over this past week and why we remain confident in our positioning. Berkshire Hathaway led our individual stock performance with a 2.36% gain after news broke that the company took a significant stake in United Health Group. This showcases exactly why we own Berkshire. It's not just an insurance company, but rather a collection of high-quality businesses run by management with an exceptional track record. When Berkshire invests in a struggling sector like healthcare today, it sends a powerful signal to the street that the selling may have been overdone. The company's steady operating performance across diverse businesses provides exactly the kind of reliable earnings growth that supports long-term wealth building. Healthcare was our strongest performing sector, contributing 0.16% to returns as the entire industry staged a remarkable comeback. Companies like Eli Lilly, United Health, Merck, and Johnson & Johnson all posted solid gains as investors remembered that these are companies providing essential services with strong cash generation. What's particularly appealing about the healthcare sector right now is the combination of defensive characteristics during uncertain times and the attractive valuations after the recent sell-offs. The companies benefit from aging populations, innovative treatments, and resilient spending regardless of economic conditions. Our value strategy led performance with a 0.2% contribution as investors rotated towards companies trading at attractive prices. Leading contributions included Next Energy, AT&T, ExxonMobil, United Health, and Merck, all companies offering solid dividends, strong cash flows, and reasonable valuations. This rotation makes sense as investors are positioning ahead of potential Fed rate cuts, which historically benefit cash-generating companies trading at reasonable valuations. Our focus on high-quality value names should continue benefiting from this environment where investors reward substance over speculation. Looking ahead, here are the key events we're monitoring that could shape markets in the coming week. Tuesday brings 2 important economic readings, with July durable goods orders and August consumer confidence data. Durable goods orders measure business spending on long-lasting equipment, a key indicator of corporate confidence in future growth. Consumer confidence tells us how optimistic Americans are feeling about jobs, income, and the overall economy. Strong readings would signal that businesses are still investing in growth and consumers remain willing to spend, supporting holdings in both business equipment companies and consumer-focused businesses. These reports help us gauge whether the economy maintains enough momentum to support future corporate earnings growth. Thursday's second estimate of second quarter GDP will provide an updated look at economic growth during the spring months. The initial reading showed solid 3% growth, but economists often revise these numbers as more complete data becomes available. This matters because GDP growth directly influences corporate profits, which then drives stock prices over time. A stronger revision would reinforce confidence in our equity holdings, while a weaker number might support the case for further Fed rate cuts, which could then benefit our bond positions. Friday delivers the Fed's most important inflation measurement, with the core PCE price index for July, along with personal income and spending data. This PCE reading is crucial because it's the inflation metric that the Federal Reserve actually targets. Personal income and spending data will show whether American households have the financial capacity to keep supporting economic growth. Strong income growth with moderate inflation would be ideal for our diversified holdings. This would suggest that the economy can continue expanding without forcing aggressive Fed action. These numbers will likely influence market expectations for September's Fed meeting. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thank you for joining us, and we'll see you next time.